Today's video is going to be about the retirement lever that no one's talking about. You've watched endless videos on Roth conversions, you've thought about tax strategy, you've thought about distribution strategy, but here's the one thing I know about you if you're watching this video. Two things actually. Number one, you're probably a disciplined saver. If you're watching YouTube videos on retirement planning, you've probably done pretty well for yourself and you're trying to figure out how to have an off-ramp. Number two, you're probably not a big spender. In order to accumulate the amount of wealth you need to have something to plan for in retirement, you have to forego that gratification. Now, today's video is very simple. I'm going to do a case study of a couple that is 50 years old and they're trying to determine, should we retire at 55 or 60? Here's the lever you need to think of. It's super simple. So simple you probably never thought about it. But if you're a disciplined saver, the concept of spending more money than you need is probably like nails on a chalkboard. But I'm going to make a case for you in this video that it's actually the one thing that is probably most helpful for you instead of doing Roth conversions. Now, I want to do a caveat here. This video is meant to be educational. It's not personal financial, tax, or investment advice, and it's actually not for everyone. I want you to really carefully think through what I'm trying to say here, because in reality, I'm trying to make the thesis that before you realize that you have a tax problem, realize that you probably have a spending problem. Because what is a Roth conversion, right? We're taking money that is currently taxable, we're paying the tax on it now, so in the IRS's book, what did we do? We made income. Another way to say that is we can either spend the money and pay the tax on the money that we spent, or we can move the money, not spend it, and still pay the tax. I'm going to make the argument that in a lot of cases, you can retire earlier than you think, and here's why. The one thing you need to know is you need to do a retirement plan based off of your goals, not someone else's goals, not something you saw on the internet, but what makes you happy. In reality, there's a lot of people that say, I want to retire 1 more year, 3 more years, 5 more years, because I've always been told that fill in the blank. It could be you've got to have no mortgage in retirement. It could be that you've got to spend less than what you spend now in retirement. You can fill in the blank. But what I want to prove to you here is that no matter what problem you think you may have, the solution might be easier than you think. If you're new to these videos, my name is Forrest Dutton. I am a certified financial planner, the owner of Brightworks Financial Planning. The goal of this video and all my videos is to help you retire with confidence. So let's move on to the case. Okay, let's start this off by just introducing who are our fictitious clients in this scenario. We have Bill and Susan. So Bill and Susan are both 50 years old. They want to retire, but they're not sure if they should retire at 55 or 60. Let's go through the nuts and bolts of the case. Bill has a 401k, and it's all pre-tax. It's at $2 million. Susan has a 401k, all pre-tax, at $500,000. Bill has some Roth IRA money, $100,000. He has an HSA account, and he has a taxable account at $500,000. Now, by all intents and purposes, Bill and Susan have done really well. No one would disagree with that. If anything, they're probably thinking, wait, we might have done too well. What are we going to do with all this pre-tax money when we retire? What I'm going to show you is sometimes the easiest option is the best option. So in this case, Bill and Susan have done really well for themselves. They're diligent savers. They obviously have saved a lot, and they've looked at their retirement and they thought, what are our goals? They want a retirement expense, meaning a monthly retirement expense of $9,000. They assume that when they get to annual retirement age, meaning in this case 65 for Medicare, their annual Medicare budget is $5,709 a piece. That is based off a national average. So that would be the cost of things like Medicare Part B and maybe a supplemental or an advantage plan. They want to go ahead and simulate travel for the first decade of retirement. They realize we're only going to be young once, whether we retire at 60 or what age it is. We want to retire $5,000 every year for travel, and we're going to inflate that each year. Now, where does that actually put them? Well, let's talk about their savings. So we're currently maxing everything out, right? Meaning the Roth IRA is maxed every year for Bill. The HSA for the family is maxed out. We also have Bill's 401k savings is maxed out. Now, because of those other maxes, I actually don't have anything in here for Susan's 401k, and so she doesn't get a match, so they've decided to just put all of their money into bills for this scenario. Bill has a taxable account. We're also putting in $1,000 a month or $12,000 a year. So looking at this, man, everything is running on all cylinders. Things are looking great. Where does this put them for retirement? So I'm going to show you, as you can probably guess, the answer is pretty well positioned. So what you're going to see here is on the right, okay? And this also assumes that they have Social Security and they take it at age 67. Now for this video, I can't go through every detail that would determine if that's the right thing for you, but I want you to just realize that is something I put into the scenario. I'm not going to change much in this case. Here's why. I want you to see, again, if you've made straight A's your whole life, great. But what I want to show you in this video is that you don't have to make straight A's in retirement. If anything, I would say if you are, it means you gave up something. You left things on the table. So on the right here, it says they have a 98% probability of success. The number here is basically saying the amount of money they would have left over. So they not only are they not likely going to run out of money, but they're going to have a lot of money to give. Now, for most people, their goal is not to retire, live their retirement days, and then leave a lot of money at the end of their life. That's just not the goal. They're probably concerned, saying, we've been diligent savers, we only need this $9,000 a month, we know we're going to have money left over, we're probably going to get killed on taxes. And that could be true in the future. So let's look at that first. Let's look at the year-by-year assessment of this, and I'm going to show you what this actually looks like. So no need to get too detailed here, but in reality what you're going to see here is every year you can see their tax payments right in the middle as they go from retirement at age 60. Looks pretty good for a while. And then you're going to see at age 75 it's going to start to really jump up. So we have over a $20,000 increase, and then it becomes a six-figure tax bill from age 77 to 90. So we're assuming that we're living to 90 in this scenario. Now, is that okay? We're about to find out if that matters or not, right? Because if this is their main concern, what if we have these taxes that are higher? Well, there's a couple things you could do. Obviously, we could model Roth conversions, but for this scenario, I want to just say, well, in this case, since we have a 98% probability, the probable answer to not only have a more fulfilling retirement, but also to mitigate some of your tax burden is simply to retire earlier. So what does that actually look like? So if I go to this, I'm only going to make two changes in this scenario, just to make this easy for you to see. The first change I'm going to make is the age of retirement. Okay, so I'm going to show you that on the left. So you're going to see on the left here, Bill and Susan's retirement age, I've moved it to 55. So instead of 60, we're going to retire at 55. Why is that attractive? Well, number one, they do have a fair amount of taxable assets, so they can start to live off of those before they reach 59 and a half. So it's a viable path, number one. Number two, they're healthy. And there's another change that you need to see here is I actually have them spending more money in retirement, right? So not only do they retire earlier, but they spend more money. Instead of $9,000, they retire on $11,000. And there's one change that I made to savings. I simply back down how much they're already saving in their pre-tax accounts. So remember, we already are going to have money left over. We don't really need to feed something that is going to cause more taxes in the future. So in reality, what I've done is I've flipped their taxable account savings and their 401k contributions. Now, Bill would still get the match here, whatever his match is in his company. So I just put $9,000 in here. But basically, we're putting all our extra dollars to work in taxable savings because earlier we retire, the more flexible we can take withdrawals from that taxable account. So if I did that, as you can see up top, we went to a 72% probability. Now, for some of you watching this, you may think, whoa, that really scares me. 72, that's a C. I'm barely passing. But in reality, I need you to reframe that number in your mind. 72% basically means that there is a 72% probability that you, again, will outlive your money, meaning if you make zero changes, right? So another way for you to think about this too is there is a probability and a likely probability that you'll have to change your spending habits at some point in retirement. Now, I would submit to you that most people do this anyway. So I'm actually going to show you that, and if that 72% number makes you nervous, I'm going to show you why it shouldn't. So before we move on to that, I want to show you what the tax difference is here. So if you were someone who was concerned about taxes, what I'm going to show you here is you may want to think about what is the lifetime tax between 55 and 60. Remember, they have a lot of pre-tax assets. They might be thinking, well, we have to do aggressive Roth conversions. Well, in reality, you may or may not. Just by retiring early, you've already knocked down your tax burdens. Okay, what you see on the screen here is a column that I pulled out. I have on the left retire at 55, and I have on the right retire at 60. So we have years 2026 all the way until 2068 when we are 90 years old. Now what I want you to see here is simply by retiring earlier, we are cutting down our lifetime taxes significantly. Now, to really compare this, we'd have to look at different Roth conversions, etc. But what I want to show you is you did a form of conversion of your lifetime tax without actually having to withhold the gratification, meaning you lived on the money earlier and you still paid less lifetime tax. So there is another way, is what I'm trying to show you. So what's interesting, if you go into the details here, there's actually a couple years at the beginning where you pay a little bit more in tax. The reason on the left is the reason because you're actually choosing to flip, remember, your 401k contributions and your taxable account. So you're not getting quite the deferral that you're getting for those last 3 to 5 years of retirement. But overall, you are much better off in your lifetime tax by retiring early. So now let's go back to the software and I'll show you the rest of why this is worth considering. So if I go here and I show you how are we spending that money, if we go to the scenario where we are actually retiring early, it's not just what the tax payments are, it's the sequence of them, right? So we have a benefit here of these early years where we're not paying very much in taxes, but we also are not worrying too much about Roth conversions, because what we're doing is, if in the event that we outlive the taxable account, meaning it's going to be drawn down, and I can show you that. So basically the taxable account is going to be drawn down between the ages of 55 onward. What's happening then is we're having some distributions from tax deferred accounts, and in that case that's helping to mitigate some of those future withdrawals. So you can see these first years we lasted until about 59.5 or 60, which is what you want anyway, by taking withdrawals from taxable. And then at age 60 we start taking sizable withdrawals from our 401ks, which is perfectly fine, right? Because at 75 we're going to be forced to start taking more of that as well. And the reason this drops down is not that the withdrawals continue, it's just a different type of withdrawal. It would be called a required minimum distribution. So remember, that would flip to 197 at that point. So the point of showing you this is that this probability and likelihood of this plan is still a very viable plan. And not only is it a viable plan, but you saved money on taxes, right? So if you don't want to have to go with the route of I'm going to do aggressive Roth conversions and have to live on less than I want to, the flip side of that is live on more now. Live on more when those years are going to go further. Live on more when even if you don't spend it, you can give it. It's the same thing. If you convert it and it's in a Roth and your kids don't get it until they're older, they might need it now, right? These are reasons to do this. Take your family on a trip while they still have kids and you want to see your grandkids experience the beautiful things that you want them to see. These are reasons why you could actually retire in that first decade, 55 to 65. There's a lot you can do during that time. So that's the first point I want to make. But I want to go back to those of you that might be viewing this and it still makes you nervous. If that's the case, I'm going to show you the have your cake and eat it too plan. Okay, so what that means is basically instead of just inflating your income or your expenses your entire retirement period, why don't you just make your expenses less after your first decade? So if 72 is not a score you like, if you would like to have it statistically higher, all you have to do is change how you view your spending in retirement. And this is something that you would have to assess if it's something you're comfortable with. So let me explain to you what this actually looks like. And I think this will make intuitive sense. So basically what you're going to see is age 55 we have an expense number, and we go all the way to 65, and at that decade, it just resets. So we have a big reset in our income expectations after the first decade. So instead of inflating from 191,000 each year from 55 to 65, we go back all the way down from 231 to 200. Now, if that's something that makes you cringe, then maybe this isn't the plan for you. But for a lot of people, if you were to tell them you can spend a decade full of memories, full of things that you'll never be able to do again, and you're going to have that time, your health. The only catch is when you get to 65, you have to change your income a little bit. If that sounds attractive to you, then this is still a very, very viable plan. And then the only other thing I changed in this plan is that when you get older, your last 3 to 5 years, there's a little bit more spending just for things like healthcare. So anyway, hope this was helpful. I wanted to give you a different perspective on this. Tell me what you think about it. I would love to know what your take is on how I view this retirement spending plan. Meaning, there's a conversion, you haven't thought about it. It's not a conversion, it's spending and it's retiring early. Because by definition, all of you out there that have tax planning problems, you first have a spending problem. Meaning, all you know how to do is save. You've done it so well that flipping that switch is really difficult. So all I'm encouraging you to do is look at this from another lens and say, would I be just as happy if I didn't go with the aggressive tax planning strategy, or I just went with the early spending and the living strategy, which is almost like an anti-conversion. So in this case, I would love to know what your thoughts are. I know it's a little unorthodox, but I think it makes sense. And what did I leave out? What are the variables that you'd like to see? Now, just to reiterate, this isn't a personal plan. This isn't something that is meant to be personal advice. There's obviously many other variables you could take into consideration for this plan. I just wanted to get you thinking through this and realizing that there's another way to save on taxes, and it's just to spend the money earlier, spend it more in proportion with what you have. And if you do that, you can still have a similar result to what you would have in a Roth conversion scenario. So hope this was helpful. Please like, comment, subscribe to the channel. That's how I reach more people. I want to help as many people as possible retire with confidence. I will see you on the next video.